This Wednesday sees the latest FOMC rate decision, and it comes in a week which has a huge amount going on, quite frankly. Mag 7 names reporting, of course, the FOMC, the US potentially attacking Iran, Russia-Ukraine talks over last weekend's continue into the next weekend, the possibility of a US shutdown at the back end of the week, 100% tariffs on Canada. I mean, you name it, there's a lot going on, certainly for sure. And certainly precious metals have been probably the biggest story at the moment in terms of price action. But nonetheless, this Wednesday's FOMC meeting does provide the basis for us to get a grasp of exactly where monetary policy goes over the near term. And it comes at a time where there's question marks around who will be leading the FOMC come May. So let's look at this meeting and those question marks around the Fed's chair position in May, because we have a new leader when it comes to that contest, according to betting markets. So first and foremost, this is the outlook in terms of the Fed's dual mandate. Remember, they need to control unemployment. So they need to control the jobs market, and they need to control inflation. Inflation, they want somewhere near 2%. Unemployment, they just need essentially at the sort of norms. And at the moment, that is sort of roughly around 4%, 4 to 5%, as you can see pre-pandemic, that sort of grey band. And we're in the middle of that at the moment as well. Of course, we saw the shutdown. So you can see that gap in the middle of the data when it comes to the unemployment rate, but at 4.4 or 4.45 to be exact, it's still under control. In terms of the core PCE price index, we saw the latest inflation gauge last week, and again, that appears to be under control as well. So both of them have gone from unemployment rising and inflation rising to inflation by and large under control, unemployment by and large under control. You can look at secondary metrics, of course, and under that, you'd probably say the jobs market is more of a concern than the inflation picture, because we're not necessarily seeing any inflation metrics that point towards an imminent spike in prices. But we are seeing weakness in terms of the jobs market when it comes to the likes of payrolls, ADPs, and the like. In terms of the inflation picture, like I said, we haven't seen the signal that inflation is rearing its head, despite some of the other metrics that in the past had pointed towards such a move. That is one thing being the prices paid element within both ISM, manufacturing and services PMIs. I've lagged it by 6 months, but essentially you can see that we saw a surge in both the blue lines that we just haven't seen in terms of the core PCE sort of 12-month figure. But also, if you look at the near term, so the 3-month annualized, what happened over the past 3 months, and what would that look like if that was an annual figure at that pace of inflation? Well, none of them have really reared their head of late. So inflation, not necessarily a massive concern at the moment. I think it's likely to sort of drift lower. And certainly those tariffs haven't sparked a surge in terms of price pressures. Unemployment has been on the rise, but as you can see here, I sort of marked the 4.5% here on with the attached to the green line. The rise in unemployment in the US is very gradual in nature. It's still below many of their sort of developed world peers. And some of these other countries have been seeing much more significant rises in terms of unemployment, in terms of the pace of that rise as well. So not necessarily a massive concern, I would think, when it comes to unemployment. But like I said, we also have the weakness of the payrolls and some of these other metrics that do sort of point towards the potential need for them to do more. Now, one thing I thought would be worthwhile is looking back at the FOMC projections from December and seeing exactly where we stand in relation to that. So unemployment, they expected it to remain pretty much at 4.5, then go down to 4.4, 4.2 in 2027, and then 4.2 again. So essentially roughly where we are, and then sort of drift a little bit lower. So we're there, right? In terms of the core PCE price index, 3% for 2025, then down to 2.5% for 2026. You can see that's a downgrade from where they thought things were going to be in September. So they're already thinking things aren't as bad as they had previously thought was the case. And so 2.6%, well, as we, oh, there we go. In terms of core PCE, currently at 2.8. So a little bit elevated compared to that, but certainly if you look at the month-on-month metrics, it does signal that inflation is yet to really rear its head. And certainly if we look back here and look at things from a, say, 3-month or 6-month annualized perspective to say, you know, at the current pace of inflation, where would we be? Both of them are below 2% at the moment. So inflation appears to be under control. Also notably is that we have the Fed funds rate projection down from 3.6 to 3.4 for 2026. So the Federal Reserve aren't expecting to do much for this year. 3.4 means essentially one rate cut for the year ahead. And so let's look at exactly what the market predictions are. As you can see at the moment, it's a toss-up between one rate cut kicking off in June and two rate cuts, with that second rate cut potentially coming into play at the back end of 2026. That's October or December. For the time being, this meeting is a 97% chance that we see a hold. So don't expect much by way of policy shifts. But also markets pricing in a 74% chance that we see holds for the next two meetings as well, essentially until Powell's out the door. And that brings us to the topic of who will replace Powell and what will it mean for markets. So Rick Rieder is the new person at the front of the line. And that's because we've seen a sharp spike in terms of the betting markets. This is according to Kalshi. Over the course of the past few days, we've seen a surge in terms of betting away from Kevin Walsh into Rick Rieder, who is the CIO of BlackRock, or a CIO of BlackRock, working particularly in the fixed income space, managing money in the trillions. So one thing that would be positive coming into that role is that there would be a perception that he is the kind of person that would stave off any sort of crisis in terms of being able to manage the rates market in particular. The question mark here really when it comes to who gets appointed is, do they have the credibility in terms of markets? Yes, to an extent, but also the rest of the Federal Reserve, because it's one thing saying you're going to appoint someone that wants to drive down rates to 1%, let's say, which is what Donald Trump supposedly wants. It's another thing that person being able to get the rest of the board to vote in favor of dramatic easing, when at the moment they are, according to projections, pointing towards a single rate cut this year. That doesn't scream a committee that's desperate to cut rates at a dramatic clip. So would he be convincing enough to be able to take people with him? Well, one other way in his favor, or Trump's favor, has been the idea that they are going to be able to replace members of the committee apart from the Fed chair. One is Stephen Mirren came in. The two is the removal of Lisa Cook. And of course, over the course of last week, we saw the Supreme Court hearing into the removal of Lisa Cook. And according to Reuters, there is a skepticism between those in the Supreme Court around the bid to fire her, indicating that there is a belief that this essentially is a case of trying to chip away at the independence of the Federal Reserve. Now, if Lisa Cook doesn't get pushed out, then it makes it more difficult for Trump to be able to start to build not a majority, but a significant minority of very dovish members for the Federal Reserve. So that's certainly something to be looking forward to in terms of exactly how that plays out. If she stays in her role, she's probably not going to be desperate to do exactly what Trump wants her to do, because he tried to get her booted out. Now, worthwhile noting that that comes, of course, at the same time as the DOJ essentially tried to start legal proceedings against Powell, and he's called it unprecedented. He has lashed out. There is a feeling within the Federal Reserve that they are trying to undermine their independence, and that to a large extent plays into why we're seeing this sort of this hawkish narrative, because the Fed members aren't necessarily in a position where they want to be sort of puppets for the president. They feel strongly that they need to be independent, and they've done a fair bit over the course of the past couple of years. And so maybe it's time for them to pause. And that's why markets don't expect anything until the new Fed chair comes in. Now, whether that new Fed chair is the kind of person that will be able to straight away turn around the group and say, right, we need to start easing in a dramatic manner, and that they will listen and adhere to that, that remains to be seen. But certainly as we go forward, the perception of who's good and bad in terms of monetary policy, I mean, ultimately, you know that every single one of these prospective Fed chairs comes in on a ticket of I want to ease, because otherwise Donald Trump just wouldn't put him in that position. The question mark for Trump is who would be able to do that job the best. And that's what I think he's doing at the moment. He's trying to weigh up who will be influential enough and credible enough to come into that position, and the group essentially follows them. So that remains to be seen. And that's why someone that's a little bit more left field, someone that has strong credibility within the markets, it's probably a better pick than one of your right-hand men, because, I don't think that they'll necessarily listen to them to a great degree. Like I said, for this meeting, we're not expecting too much, but a period of hesitancy for the Federal Reserve, where markets are pricing a base case scenario that breaks in June, but we don't necessarily know that's going to happen, of course. Now, let's just jump onto the charts and see exactly what's what. This is the dollar index. The dollar index has been hit hard as we kick off the week. And in part, that's because we've been seeing a story around the Federal Reserve potentially looking to step in, helping enact FX intervention on behalf of the Japanese. So selling US dollars, buying Japanese yen to try and sort of stem the decline of the yen, amid serious concerns that we're seeing at the moment in the lead up to the Japanese election, that by and large looks like it could see Takaishi gain a stronger foothold in a position that she is expected to utilize to ramp up spending, which isn't ideal for a country that already has 240% debt to GDP ratio and rising. So in terms of the dollar index, you can see here that we're sort of within this sort of consolidation phase, but heading towards the bottom end. So support comes down here at sort of 96.3. The wider context, of course, points towards this being a potential sort of pause. We didn't know if this was going to be a bottoming out, and you could see a breakthrough that 100 odd mark would have sort of start to make things look a little bit more positive, or whether it was a continuation pattern. The big caveat to this, of course, is that if you overlay the first 4 years of Trump being in power over the current period where Trump's been in power, and you look at the dollar index, well, it's pretty much going hand for hand exactly what's played out, except for if you look at exactly how it played out previously. So you can see he came into power in April, we've seen declines, then we saw a bit of a consolidation phase, and pretty much around now, if you look back at the first time he was in power, we saw that next leg lower. And it was the final leg lower, ultimately to them a bottom and a prolonged period of strength. But it did have another leg lower. So that signals the possibility of another leg lower from here. And certainly, I think if you time it, it could come around about the time that actually we have the new Fed chair. So is there a possibility that we get the new Fed chair in and they don't manage to ease to the extent that markets are pricing or expect, and that essentially sparks the bottom? Potentially. Bearing in mind, we've got the potential shutdown coming out at the back end of this week because of the ICE killing in Minneapolis. Now we've got the Democrats pushing back against the funding bill. So that's another sort of story around the dysfunction in the US and a potential reason for further downside to come for the dollar index. But certainly things looking pretty bearish at the moment. In terms of gold, I mean, look, it's the same story over and over and over again. It keeps going up, and you know, there's so many different narratives on the bullish side, and there's very few playing in terms of the bearish side. I would say maybe one of the bearish sides of it is the fact that we're now entering a phase where we could see rates pausing for quite some time. But then there is the narrative being built around the idea that, well, once Trump gets his person in, they essentially have promised to try and ease to a great degree. That might be lower rates, that might be QE, you name it. It all potentially plays into strength for gold. So the outlook for rates going forward will be key, in particular for gold. The caveat is that, you know, you could say that we have a little bit more of a hawkish stance from the Federal Reserve. That doesn't necessarily mean that gold's suddenly going to sell off in a meaningful manner, because there's, you know, another 5, 6, 7 reasons why gold and precious metals have been performing so well. So as things stand, you know, I do think this trend's likely to continue. At the moment, we're really seeing sort of minimal pullbacks, very shallow retracements, sort of pops, sideways pop, shallow retracement, pop. You know, if we see another retracement, you just constantly sort of ticking along each of those swing lows and following it like that. And if you see a breakdown through your latest, which currently is sort of 8,900, Then you look at the sort of wider context and say, okay, do we sort of retrace a wider rally? But certainly, I still think there's further legs to run on this gold trade. And then finally, looking at the Nasdaq, it's going to be a massive one for the week ahead. We've got 4 of the Mag 7 names reporting over the course of Wednesday and Thursday. And certainly, we've come off the back of a period that has seen significant, how do we put it, rebalancing in terms of the distribution of the S&P 500, because of the fact that people have been really jumping into the rest of the market, the 493s rather than the 7s. And so the Mag 7 names have sort of lagged a bit. Not necessarily a bad thing, quite frankly, because you need to see some of the heat taken out of it. It can't just be just one single sector. And so, maybe that's a good thing. And coming into these earnings, which generally come out strong, could be the basis for another leg higher here for tech stocks. And that's why I thought I'd look at the Nasdaq. You can see here coming into these deep retracements and then popping higher. So resistance over the near term, 25827, with the break through that level, then pointing in the direction of let's get that out of the way, of a potential move to 26255, which I believe is your record high. So the trend still remains in play. We've been in consolidation mode for a while. That's not necessarily a bad thing. And certainly if earnings come out strong, and if we see a Federal Reserve that, okay, they could be a little bit patient in their approach, but markets are still expecting to see a shift at the top before too long, and the possibility of a relatively expansive outlook for the back end of the year, then, things still look relatively strong for the tech stocks. At some point, that gravy train sort of rolls over in terms of that bubble bursting, but those bubbles can blow for quite a while, and it's in my mind, I think it's likely we're going to need some sort of signal of a turnaround in terms of the earnings for a handful of these names to break things. And so this week ahead will be key, not only for the FOMC, but also for those earnings. I hope that's useful for you guys. Make sure to like, subscribe, follow for more. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.